Get your free copy of the complete tutorial at www.teachucomp.com/free.
An accounting method is a set of rules for reporting when a company earns and spends its money. You must choose an accounting method before you file your first income tax return and use the same method from year to year. It is a good idea to consult with an accountant or tax preparer to determine the accounting method that your business should use. While there is no single accounting method required for all taxpayers, you must use a system that clearly reflects your income and expenses and enables you to file a correct income tax return. You must also keep any other records necessary to support the entries made into your accounting system and reported on your tax returns, such as receipts and bills. Once you select an accounting method, you must use that same method from year to year. The only way that an accounting method can clearly reflect financial data is if all income and expenses are treated the same way from year to year. If you want or need to change your accounting method later, you must first get approval from the IRS. Generally, this requires that you file a current version of IRS Form 3115 to request a change to your accounting methods. GAAP, or Generally Accepted Accounting Principles, are the common principles, standards, and procedures used in accounting. GAAP is a combination of authoritative standards set by a group of accounting entities that shows accepted ways of performing accounting. The following GAAP accounting methods are listed in IRS Publication 538, Accounting Periods and Methods, which defines the methods that are acceptable for filing taxes. The cash method of accounting. This accounting method is one in which revenues and expenses are recorded on the date when they are actually received or spent. For example, if you invoiced a customer in December of 2004 and received payment on that invoice in January 2005 using the cash method of accounting, the income would then be reported in the accounting period of January 2005. Likewise, if you receive a bill in December 2004, but do not pay that bill until January 2005, then the expense is recorded in the accounting period of January 2005 under the cash method. The cash method is often used by small businesses or service-based businesses for income tax reporting. There is also the accrual method of accounting. In this accounting method, revenue and expenses are recorded on the date in which they are actually earned or incurred, regardless of the date on which the money is actually received or spent. So, for example, if you invoiced a customer in December of 2004 and received payment on that invoice in January 2005 using the accrual method of accounting, the income would be reported in the accounting period of December 2004. That was when the income was earned. Likewise, if you receive a bill in December 2004, but do not pay that bill until January 2005, then the expense is recorded in the accounting period of December 2004 under the accrual method. That would be when the expense was actually incurred. This accounting method is generally required in order to conform to GAAP standards in preparing financial statements. There are also special methods. And there are a few special circumstances where special accounting methods are used for specific types of industries in order to report taxes to the IRS. If consulting with your accountant or tax preparer first, you can find out if your industry must use one of these methods. More information can also be found on reporting income using one of the long-term contract methods in Section 460 of the Tax Code. IRS Publication 535, Business Expenses, discusses methods for deducting amortization and depletion. The following publications also discuss special methods of reporting income or expenses. IRS Publication 225, Farmer's Tax Guide, IRS Publication 537, Installment Sales, and IRS Publication 946, How to Depreciate Property. You can also use combination or hybrid methods. So as a general rule of thumb, unless specifically required for other reasons, you can use any combination of cash, accrual, and special methods of accounting as long as the combination clearly reflects your income and you use it consistently. However, the following restrictions do apply. If an inventory is necessary to account for your income, you must use an accrual method for purchases and sales. However, there are a few exceptions to this rule, which are listed in IRS Publication 538. Generally, you can use the cash method for all other items of income and expenses. If you use the cash method for reporting your income, you must use the cash method for reporting your expenses. If you use an accrual method for reporting your expenses, you must use an accrual method for figuring your income. Also, any combination that includes the cash method is treated as the cash method for purposes of Section 448 of the Tax Code. Let's briefly recap the main difference between the cash and accrual accounting methods. Cash is the accounting method in which revenue and expenses are recorded on the date when the cash is actually received. Accrual is the accounting method where revenue and expenses are recorded on the date that they are earned or incurred, regardless of when the cash is received or spent. Which method is right for your business? It is best to consult with your accountant or tax preparer to know for certain, but we will give you more details about these methods to assist you in deciding. Remember that the cash method does not take into consideration payments that are due to be received or paid by the company. This method does not count the value in accounts receivable as income, nor does it count the amounts in accounts payable as expenses. Instead, the expenses are recorded when they're paid, and income is recorded when you receive payment. While most businesses use the accrual method, you should review your choice with an accountant. Both methods can have their own pitfalls when it comes to tax time. For example, assume that you start a new business and use the accrual accounting method. Then assume that you bid on and receive a government contract for $500,000 at the end of the first year that would not actually be paid to you until later into the second year. The accrual method would require reporting the income on the date the contract was signed, so therefore you would be taxed on the $500,000 even though you may not have funds to cover that tax payment. This could become a very real problem for new business owners to overcome. Small businesses that have sales of less than $5 million per year are free to choose which accounting method to use. However, if your business stocks inventory items that you will sell to the public, the IRS will typically require that you use the accrual method of accounting. You should check with your accountant to be sure. Inventory includes any merchandise you sell, as well as any supplies ordered that will physically become part of an item intended for sale. Whether you use the cash or accrual method, it's important to realize that both methods only show you a partial picture of the financial status of your business. While the accrual method shows the ebb and flow of the business's income and expense more accurately, it may leave you in the dark as to what cash reserves are actually available, and that can result in a serious cash flow problem. For example, your income ledger may show thousands of dollars in sales, while in reality your bank account is empty because your customers haven't paid you yet. The cash method will give you a true idea of how much actual cash your business has, but it may offer a misleading picture of longer-term profitability. For example, using the cash method, your books may show 1 month to be spectacularly profitable because old customers paid late invoices, when in reality, new sales levels fell.
Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.